Hello students, welcome to today's session on various accounting ratios. So students, in my earlier video, I have told you about the objective, advantage and limitations of accounting ratio. Now in this video, I will take you through doing questions on finding out these ratios. Okay. So different types of ratios, we have different types of ratios here. So usually for our um, for the convenience of the students and for better understanding purpose, these ratios are divided into four categories: liquidity ratios, solvency ratios, activity or turnover ratios, and profitability ratios. Liquidity ratios are basically found out calculated to meet the company's commitments, business needs. The ability of the business to pay the amount due to stakeholders as and when it is due uh, is found out through these liquidity ratios. These ratios are usually short-term in nature. Then solvency ratios. What is solvency? Solvency of a business is determined by its ability to meet its contractual obligations towards its stakeholders, particularly towards the external stakeholders. And this ratio is calculated to measure solvency position. Right? Thus, these ratios name is solvency ratios. These are essentially long-term in nature. Then we have activity or turnover ratio. This refers to the ratios that are calculated by measuring the efficiency of operations of business based on effective utilization of resources. Hence, these are also known as efficiency ratios. Then the last set of ratios are the profitability ratios. This refers to analysis of profits in relation to revenue from the operations or funds. Okay. Now let's start with these ratios. Okay. The first set of ratios as we are taking is the liquidity ratios. Now under this we have two types of ratios or two ratios, current ratio and quick ratio. Okay. So let me write down the formulas for these two ratios very quickly. Okay. Current ratio is current asset upon current liabilities, and quick ratio is quick assets upon current liabilities. Now, what are current assets? Students, you would have seen the balance sheet. On the asset side, we have non-current assets and current assets. Current assets, that is those assets which are going to be realized the company in short run, that is within 1 year. Right. So this includes the current investments, inventories, trade receivables, cash and cash equivalents, short-term loans and advances, and other current assets such as prepaid expenses, advanced tax, accrued income, etc. Current liabilities, again on the liability side, you would have seen non-current liabilities and the current liabilities. Current liabilities are again for the short-term period only. So this would include short-term borrowings, trade payables, other current liabilities, and short-term provisions. Okay. Then as we can see here, there is one more type of asset, that is quick asset. So quick assets are what? Quick assets means current asset minus inventories and other current assets. Okay. So this is how we calculate the formula or I'll write down the formula for quick assets very quickly again. Okay. Before we take it to the question. Now let us take a question and try to calculate these two ratios. So students, as you can see, this is the balance sheet of a company called Title Machine Limited as on 31st March 2017. Okay. And from this balance sheet, now we have to find out both the ratios, that is current ratio and liquid ratio. Quick ratio, students, is also known as liquid ratio. So fine, we are going with, so let us have the formula here down here so that we can make the calculations. So let us first find out the current ratio. Okay, so let us understand what all are there in the current assets. Current assets, it comprises of 12 lakh, 9 lakh, then 2 lakh 28,000 and 72,000. We add it up together and we get how much? 28, 3 lakh, this 3 lakh, 24 lakh. Okay, so this makes it 24 lakhs together. Okay, so 24 lakh is my current asset. Now let us find out the current liabilities. Let's scroll a little up here. Current liabilities comprise of short-term borrowing 6 lakh, 23 lakh 40,000 here and 60,000 here. This makes it how much? 24 lakhs plus 6 lakhs. That is, does it come to 30 lakhs? Yes, it comes to 30 lakhs. So current liabilities are 30 lakhs. Now let us find out the values. Let us put these values. This is 24 lakhs divided by 30 lakhs. Okay. And what ratio do I get here? Okay. So dividing these two, I get a ratio of 0.8 is to 1. Is to 1. This is my current ratio. Now let us find out the quick ratio. Okay. Now, as I said, for quick ratio, we have to have quick assets. So what all are the quick assets given out here? Quick assets are current assets minus inventories. Okay. So that means now, since in this question, everything is given to us. Total current assets are 24 lakhs. Out of from this 24 lakhs, we take out inventories, which is 12 lakhs. Okay. So what is remaining? 12 lakhs. So this 12 lakh is my quick asset. So using this figure again, I'll find out this ratio. This is 12 lakh divided by 30 lakh, right? And therefore, this ratio comes how much? This ratio is 0.4 is to 1. Okay. So this was about these liquidity ratios we have already covered. Now we talk about the solvency ratios. Okay. So in solvency ratios, we have debt equity ratio. Then apart from this, we have proprietary ratio. Okay. Then we have total asset to debt ratio. And then we have interest coverage ratio. So we have these 4 ratios which we are going to study in this solvency ratios. Okay. So let's start with debt equity ratio. Okay. Now, as the formula goes, debt equity ratio is, that is a ratio between long-term debts of the company divided by the shareholders' funds, that is equity of the company. Now, When we say shareholders' funds or equity, what all would be comprised in this? So, shareholders' funds comprise of the share capital, reserves and surpluses, money received against share warrants, and share application money pending allotment. Okay, this all would comprise of this thing. Acha. Then we have just now talked about share capital. What all comprises the share capital? So, as we know, there are two types of shares issued by the company. That is equity share and preference share. So, share capital arrived in equity as equity share capital and as preference share capital together, summed up together, makes the share capital of the company. Okay, then we have this. Then suppose all these figures are not given to us in the question. Then what do we do? Then in that case, the shareholders' funds is non-current asset plus working capital minus non-current liability. I'll write out these formulas for you. Okay? And then what comprises of working capital? Working capital is what? That is current asset minus current liabilities is my working capital. Okay. So all these so we can use these formulas to find out this thing. I'll take up few more ratios together and then we can do the question using all the ratios. Then we have another ratio called debt to capital employed ratio. Now, this is a ratio between the total debt or long-term debt, right? We are talking about this is a long-term ratio. So, long-term debt or total debts divided by total capital employed, that is net assets of the company. Now, this total capital employed, how can you calculate this? This can be calculated using long-term or adding long-term debts with shareholders' funds. Okay. So, I'll write this ratio first here. Yeah. Okay. So, so as I said, total capital employed can be calculated by summing up long-term debts and shareholders' funds. Alternatively, the total capital employed can also be uh, taken as the net assets of the company. That is total assets minus total liabilities. Right? Then we have the next set of ratios, that is proprietary ratios. So proprietary ratios, the formula for proprietary ratio is this, that is shareholders funds divided by capital employed or net assets. Okay. So through this ratio, what do we find out? Through this proprietary ratio, we find out the status of or the magnitude of the proprietor or shareholders funds in comparison to the total capital employed or net assets of the company. Then we have next set of ratio is that is total asset to debt ratio. That is a ratio between the total asset vis-a-vis long-term debts. Idea behind this ratio is that um, uh, the creditors or the investors of the company are very much interested to know whether their long-term debts can be serviced through the assets of the or current through the available assets of the company. Okay. Now, so now we can understand all these ratios using a question. So let's do a question and find out or calculate these ratios. As you can see, this question calls for calculation of debt equity ratio, total asset to debt ratio, proprietary ratio, and debt to capital employed ratio. Okay, these many ratios need to be calculated. That means all the four ratios that we have studied till now can be calculated. So let us start with debt equity ratio. And let's write the formula from here first. Long-term debts upon shareholders' equity or shareholders' funds. Now let us see where are long-term debts. Long-term debts or long-term borrowings are how much? 1,50,000. Okay. Yeah. And then next is shareholders funds or equity. So what all is comprised in equity? Where is the equity? Equity means the share capital and the reserves and surpluses. That is 4 lakh and plus 1 lakh. That makes it 5 lakh. So let us do the calculation. Long-term debts are 1,50,000. That is long-term borrowing. Shareholders funds or equity is share capital 4 lakh plus reserves and surpluses 1 lakh, which makes it total 5 lakhs. Okay. So now how much is the ratio? Let us calculate the ratio using these two numbers. And what do we find? 0.3 is to 1. Okay. Then now let us see which is the next set of ratio. We have to calculate total asset to debt ratio. This ratio has to be calculated. Total asset to debt ratio. Let us see what is the value of total asset given to us here. So the total asset value is how much? 7 lakh. It is given already given here. That is 4 lakh to be fixed asset, 1 lakh non-current investment, which makes it 5 lakhs, and 2 lakh is the current assets. Total value of asset is 7 lakh divided by long-term debt. Long-term debt we have just now taken, that is 1,50,000. So let us use these numbers to calculate the ratio. Okay, right? And how much ratio do we get out here? This is 4.67 is to 1. 4.67 is to 1. So now from this ratio, this can be easily made out that the value of total asset is such that the long-term debts can be serviced very easily. Okay. Now, then let's again talk about this. That is, next is a proprietary ratio. Okay. So proprietary ratio is, let us take the formula of proprietary ratio also. That is shareholders funds or equity, which is 5 lakh divided by capital employed. That is my net assets. All right. So how much do I get there? As I said, shareholders funds or equity is 5 lakh. And then my total assets. Total assets, we have just now taken 7 lakhs. Okay. So let us use these two figures. This is 5 lakh divided by 7 lakh. Okay. Now, and the ratio that I get here is 0.23 is to 1. Is to 1. So proprietors share in the total capital employed of the business is 0.23%. Yeah. Then the next set of ratios, we have debt to capital employed ratio. So now let us take the formula of this ratio also, debt to capital employed ratio. Okay. Now, this is the ratio between the total debts and total capital employed. So total debt, or that is long-term debt, is how much? Now, 1,50,000, which is already given, right? Then capital employed is shareholders' funds and long-term borrowings. That is, shareholders' funds are how much? Let's see, shareholder funds are 5 lakh, long-term borrowing is 1,50,000. So let us see, use these numbers, 1,50,000 divided by 5 lakh plus 1,50,000, that is 6,50,000. Okay. And the ratio that we are getting using these two numbers is 0.23, 0.23 is to 1. I think my calculation about, let me just check the calculation once. Sorry. Yeah, this calculation 5 upon 7. No, this would be 0.71 is to 1. Yes. Okay. Now, so this has completed my question. I have found out all the 4 ratios which were to be found out. Okay. Moving further, as I said, there is one more ratio still left. That is called interest coverage ratio. So I had not taken that ratio earlier because I wanted to take it later. So interest coverage ratio is the fifth type of ratio, which is part of the solvency ratio, which tells us the solvency situation of the company. Now, this ratio can be calculated using this formula: net profit before interest and tax divided by interest on long-term debts. Let's take a question in this thing and find out. No? Okay. The informations that we have here is, that is, net profit after tax is 60,000. Then there is 15% long-term debt, 10 lakh, and tax rate is 40%. We need to calculate this interest coverage ratio. Let's do it. So first is net profit before interest and tax. See, we have we are given net profit after tax. So let's make some question as some calculation. We have to find out net profit before interest and tax. So we have 60,000 here. That is net profit after tax. Okay. Then we need to add tax to it. How much is tax rate? Tax rate is 40%. So how do we find out this net profit before tax? That is, we can use a formula here. Okay, let me write the formula. This is net profit after tax, that is 60,000. Okay. Net profit after tax. Okay. Then this is multiplied by 100 upon 100 minus tax rate. Multiplied by 100 upon 100 minus tax rate. Okay. So this becomes how much net profit is. Net profit after tax is 60,000 multiplied by 100 upon. The tax rate is 40. 100 minus 40 is 60. Okay. So we do this calculation to arrive at the figure which is net profit before tax. Now this figure comes to 1 lakh. Okay. Now, but for this we need interest also. So interest also has to be calculated on long-term debts. Interest is 15% on long-term debt. So this is 15 upon 100 multiplied by 10 lakh. All right. So how much do we get here? How much is the interest that we arrive here at? So this interest is 1,50,000. Now combining these two numbers, we get this figure that is okay. This is 1 lakh plus 1,50,000, which makes it 2,50,000. 2,50,000 comes here. And then interest on long-term debts, we have already calculated this as 1,50,000, right? Now finding out the ratio between the two, we get this ratio as 1.67. 1.67. Okay. Now here this ratio is mentioned in terms of time. See, students, this is to be noted. These accounting ratios can be mentioned in three ways. One, when we mention it in ratio terms, that is, as we have seen earlier, 0.3 is to 1, 4.67 is to 1, that way, right? Or we can also mention them how many times the particular thing is there. And then we also mention them in terms of percentage. So here, this net interest coverage ratio is 1.67 times. This means that the interest on long-term debts is, the net profit before interest and tax is 1.67 times on of the interest on long-term debts. Thus, we can say that the interest on long-term debts has a coverage of 1.67 times um, on the or for from the net profit before interest and taxes. All right. So, so that's all for today's session, students. I hope you all understood the topic. Keep practicing, and I'll see you the next time. If you have any doubts, please contact me through my Urban Pro profile. Thank you.